Welcome to the Sound of Economics, brought to you by Bruegel. My name is Guntram Wolff, and in today's Director's Cut I discussed the situation in Turkey. The Turkish lira has lost significantly in value in the last few weeks, and while the immediate trigger was an increase in the political tensions between Turkey and the US Trump administration, Turkey's economy has seen its imbalances rise for a while. The IMF's latest Article 4 monitoring exercise in April pointed out that the Turkish economy has been overheating. It pointed to large external financing needs, limited foreign exchange reserves, changes in investor sentiment towards emerging markets, and persistent domestic and geopolitical risks as challenges. Noting that the economy has been resilient thus far, the IMF emphasized that macroeconomic policies should be geared towards addressing these imbalances, lowering inflation, and so on. The IMF also called for front-loaded monetary tightening to help contain inflation, re-anchor expectations, and underpin the lira. Of course, the Turkish President Erdogan refused to follow this medicine. On the contrary, he held the somewhat eccentric view that higher interest rates and tighter monetary policy would actually increase inflation and should therefore be rejected. This view, combined with the appointment of his son-in-law to the finance ministry and the political appointment of the central bank governor, further undermined trust in Turkey. And so today I'm very pleased to first be joined by Brett Zatzer, a senior fellow at the Council on Foreign Relations, who just published a wonderful blog on Turkey's economic situation. Welcome, Brett.
Oh, thanks so much for inviting me.
Brett, your blog post very much focuses on the large external refinancing needs of Turkey's economy. The IMF gave the number of about 23% of Turkish GDP in short-term external debt, so that debt that is maturing in the course of basically the next 12 months. That is some 180 billion US dollars or so. Could you walk us through the numbers and the main argument of your blog post?
Well, I think the main argument is that Turkey has financed current account deficits over an extended period of time, and it has done so through a mix of bank borrowing, firm borrowing, and a little bit of government borrowing, but it's been heavily weighted towards bank borrowing. And as a result, there's been a quite significant buildup of external debt. External debt's over 450 billion, which will be a quite substantial share of Turkey's GDP once the GDP numbers reflect the current exchange rate. And of that, over 200 billion is in the banking sector, and over 100 billion, or the bulk of the short-term financing, 100 billion of bank debt is coming due this year. So you combine the kind of accumulated cost of past current account deficits with the need to finance an ongoing current account deficit through new borrowing, and Turkey's external financing need is extremely large. I think it's, relative to the size of its GDP, it's one of the largest in the world, and Turkey has, compared to its peer emerging economies, relatively few reserves. So I emphasize that kind of Turkey's looks like a classic emerging market crisis in the making. And then I kind of tried to put Turkey's mix of vulnerabilities into a broader context and compare how Turkey is in some ways similar to the Asian countries as they headed into their crisis in the late 1990s, but also to emphasize that Turkey has some unique aspects, and in that sense, it's not going to be a complete repeat of past crisis episodes.
Well, Brett, can you walk us a little bit and discuss a little bit more the external refinancing needs? I mean, you said they are very sizable, more sizable than most of what you've seen elsewhere. Now, they are not all US dollar denominated refinancing needs. I mean, the 180 billion or so the 23% of Turkish GDP that the IMF gives, I mean, not all of that is in US dollars. Some of it must be in Turkish lira, and so there, I guess the question is to what extent external investors are really willing to go into lira, or to what extent they really are ready to hold only US dollar accounts in Turkish banks, and then the Turkish banks sort of take the risk, the exchange rate risk. So who's really exposed here? Is it more the banks in Turkey? Is it international investors that are withdrawing, or how does this work?
Right. It actually works in a kind of complicated and interesting way. International investors do have some exposure directly to the Turkish government bond market, and that obviously is denominated in Turkish lira. Most of that is going to be a little bit longer dated government bonds, so it won't technically be coming due within the next year. But obviously, foreign holders of long-term Turkish government bonds, if they find the risk unappealing, can sell those bonds, and that can put pressure on the government bond market. I think, though, that's secondary compared to the financing need of the banks. The available data would suggest that the overwhelming majority, over 90% of the 100 billion or so in bank claims that are coming due, external bank claims, is denominated in a foreign currency of some kind. It's going to be a little bit more weighted to the dollar than to the euro, but it's basically in dollars and euros. Now, those dollars and euros were borrowed and in some cases swapped into Turkish lira in the cross-currency swap market. The Turkish banks were kind of playing a game. They could borrow longer term in US dollars and in euro than they could in Turkish lira.
So at the end of the day, the center of the issue is really the banks that have not been able to pass on the foreign exchange rate risk to the corporate sector. So they would be immediately hit, or is it the case that the corporate sector, the non-financial corporate sector, has been borrowing in foreign currency and is actually facing the exchange rate risk when repaying loans that come due? You're saying it's mostly in the banks directly, the risk, or is it in the non-financial corporate sector?
Yeah, it's everywhere. The interesting thing about Turkey is that its banking system actually had access to a lot of domestic foreign currency financing. Mm-hmm. There is a large stock of domestic deposits denominated in dollars and euros. And broadly speaking, those domestic dollars and euros were lent out to the Turkish corporate sector in dollars and euros. So the risk from foreign currency funding was therefore passed on to the corporate sector. And then Turkish firms also borrowed directly from international banks. So the combined foreign currency borrowing of the Turkish corporate sector is actually quite large, 350 billion. They don't have quite as much short-term foreign currency debt coming due as the banking sector does, but they are the sector that is most exposed directly to the weakness in the lira because they've absorbed the foreign currency risk. The banks passed it on. What the banks couldn't do is directly pass on the foreign currency risk that they took on by borrowing more dollars and euros than they were generating domestically to the household sector. Mm-hmm. Household lending needs to be denominated in lira. Right. And that's where the Turkish banks got creative. That's where they used the cross-currency swap market. That's where the regulators got creative and allowed the Turkish banks to meet some of their lira reserve requirements by posting foreign currency, which acts like a synthetic swap. And so that combination has left the banking system, at least in my view, exposed to interest rate risk as well, because they have such a reliance on central bank and wholesale and other short-term sources of lira financing to support their domestic mortgage lending. So you both have the kind of classic foreign currency risk that we're familiar with, of borrowing abroad in foreign currency and lending to your firms, and then your firms, some of them are exporters, don't have export revenue, and when the currency goes down, they get into trouble. And then you have the kind of less classic risks that have come from the banking system's capacity to transform external dollar and euro financing into support for domestic lira lending.
Well, all of this doesn't sound very pretty. So what's your prediction? What is next, and what do you think should be next? What's the policy response?
Well, and as you mentioned, Erdogan is reluctant to raise interest rates, and so the Turks are not mounting a classic interest rate defense of the currency. Nonetheless, with the really steep fall in the lira, with some tighter regulatory conditions and with less availability of financing, I think there's going to be a rather sharp contraction of credit, and that will bring the current account down significantly. The question then becomes whether those creditors of Turkey who have claims coming due will extend them, whether Turkish depositors, both lira and dollar deposits domestically, will stick around in Turkey, or whether the combination of a weakened banking system, troubled firms, and an unconventional monetary framework will leave Turkey short on financing. And if Turkey is short on financing, if people won't renew their exposures, Turkey will run down its reserves and eventually will be in a position where where it doesn't have enough money to back all of its banks. And then, I think what Turkey should do is more or less bite the bullet and call the IMF. This is a problem that I think could be solved through an exceptionally large IMF program. I don't think Turkey, even when you take into account the cost of recapitalizing its banks, is insolvent. It may well be illiquid. But that would involve a loss of policy autonomy that I'm sure Erdogan would rather avoid, and it creates difficulties given the current standoff, I guess you could say, between the U.S. and Turkey over the pasture. So I don't expect that will happen quickly, and I expect Turkey will first wait and see, draw on its existing buffers, try to manage on its own, and then it may seek financing from non-IMF sources. Qatar might give the Russians a call. I'm sure others will get calls, and they may try to sort of muddle through without going to the IMF. I'm skeptical that other countries will be willing to provide the sums that I think are needed without the safety of an IMF program, but you sort of never know.
Right, and of course it also has the option, Turkey also, I guess, has the option to at least partially default on let the banks default on the external creditors. Do you think that will be pursued?
I think that's a very difficult option in this case, because I think a lot of the external credit, particularly the external credit coming due, is of a rather short-term nature. And, it would be hard to create a framework where Turkey allowed some banks to default on short-term bank loans while reassuring creditors in other banks that they're going to be safe. It'd be hard, perhaps, to differentiate between cross-border foreign currency funding and domestic foreign currency funding. So I think that the structure of the liabilities of the banking system would make a bail-in more difficult. This isn't a bank that has placed a lot of, this isn't a banking system that has placed a lot of subordinated debt and a lot of bonds in the hands of investors who understand that if there is a shock, they will be bailed in. So I think the funding structure makes that difficult. I think it is more likely that the Turks would try to organize some sort of concerted rollover, call everyone who's lent money to the Turkish banking system, try to get them together in a room and say, look, we're all better off if everyone extends their financing. Whether or not that kind of agreement could be reached in the absence of an IMF program without policy change, the coordination problems would be daunting, even with an IMF program. But in the absence of an IMF program, I think it'd be pretty hard. Now, I don't want to go too far. I think it is possible, even likely, that some of the bank's subordinated debt will be restructured. So I don't think that there will be no restructuring. But if I were to bet, I would bet that Turkey ultimately prefers IMF money to widespread bank defaults.
Well, I'm now joined by Jean Pisani-Ferry, senior fellow here at Bruegel. Jean, we have just heard from Brad that he thinks ultimately the Turkish government will want to have an IMF program. And together with Gregory Kleiss, I've just published a blog post in which we have discussed the reasons why Europe cannot be uninterested and has a big interest in Turkey and the situation in Turkey. We've argued that there are some economic spillovers through the financial system, but also through the export industry, even though I have to say I don't think these are extremely big, so I don't think they would be the primary reason why we are interested. Perhaps the more important reason is related to Turkey's crucial role in migration policy. We have an existing deal between Europe and Turkey in which Turkey has committed to combat human trafficking of refugees, of migrants. And of course, we would like to see a continuation of basically such a deal. At least we want to prevent that, and we don't know how the politics would evolve in Turkey if the situation got worse on the migrants. Now, then there's of course the geopolitical argument. Turkey and Erdogan himself have threatened to change alliances in the New York Times. Now, whether that is a credible threat is up to debate, but if it was pursued, it would be, of course, of major importance for Europe, given Turkey's critical position and crucial position in the Middle East. And perhaps I would add a fourth point, which relates to the fact that Turkish domestic politics is also European and German domestic politics, given that we have 5 million people of Turkish origin living in Germany, and those that voted in the Turkish election voted 2/3 for President Erdogan. So clearly there's also a domestic political dimension to the situation in Turkey. So I guess the question I would like to ask you, Jean, is where do we stand on the politics of providing support or intervening in the Turkish situation? When and should we, and when should we intervene as a European Union, as individual European countries?
I basically agree with you that it's not primarily an economic issue. I mean, Turkey is a large country, but it's not huge, and the spillover effects of a crisis in Turkey are more worrying politically and geopolitically than they are strictly economically. It's a bit like a crisis in Mexico for the U.S. It's very important because it's a big neighbor. It's part of the European neighborhood. It's a significant partner. There are all sorts of ties and difficult ties. I mean, also conflictual ones with refugees, with the security issues in the Near East. So it's important for Europe. Europe cannot look at the Turkish crisis as any crisis in the world. It has to have a stance. And I think, what I understand from your discussion with Brad, I think the best option, and not by accident, it's also what the U.S. concluded in the 90s when there was this big crisis in Mexico. The best option is to have it dealt with the IMF, by the IMF, as a multilateral solution, not as a bilateral one. There are also benefits in not mixing too much the particular various political and geostrategic interests we may have with the solution of the crisis. Is better to deal with such crisis through the multilateral system.
Jean, explain to our readers a little bit about how an IMF program would work. How would that be structured, I guess, and also how you would counter the criticism that we may certainly hear of moral hazard. I mean, we have had IMF programs in many countries in Europe, including in the neighboring Greece. And the debate on that was extremely toxic. So here we are talking of a balance of payment assistance program, and I'm just wondering, how should we deal with it? What should be conditions attached to it, and how do you see the politics of it going forward?
Yeah, this would be most likely. I mean, this Turkish crisis is what we economists tend to call a third-generation crisis. That essentially arises from the interlinkages between macro problem and banking problems, vulnerabilities in the financial system that magnify the crisis. It's not essentially linked to purely, fiscal and monetary policies, although they are definitely part of the problem. So the conditionality would presumably be a mix of addressing the macro dimension, also because the Turkish government is on record saying that interest rate increases fuel inflation rather than the tame inflation, and that the fiscal support they're giving is also given through, back channels. So it's typically a situation where the IMF would presumably insist on a stricter macro policy, together with measures to address the vulnerabilities in the banking system. So it may be difficult because the government definitely, seems to be reluctant. The President Erdogan himself has strange views on a number of economic issues, but that would be needed. The moral hazard argument, the moral hazard plays vis-a-vis the creditors, and the question is how you deal with creditors. The moral hazard argument vis-a-vis governments, I don't know any government having gone to an IMF program who is keen to resume and return to the IMF because it's a way to receive assistance. I mean, IMF assistance is harsh, and there would be significant political cost, perhaps a very large political cost, especially after what the Turkish government has said, after the appointment of this finance minister who is the son-in-law of the president. There would be a very large political cost having to apply for IMF assistance and to go through the program.
Yes, so I think this is certainly a critical question. I mean, how big should that political cost be, and what should be Europe thinking about that? I mean, in a sense, one can argue that the problem in Turkey, I mean, it has many root causes, including the macro policies that you emphasized very much, and also some of the banking issues that Brad talked about. But there's certainly also the aspect of loss of trust in Turkey as a country because of the appointment of the son-in-law into the finance ministry, the political appointment at the central bank. So this sounds like, I mean, in many respects, like chronism that we are not used to for a country like Turkey. I mean, this sounds more of a sort of low institutional quality third world country, and so I think investors, in a sense, have a sort of are wary about this. And I guess then on top of that, there is the dimension of the fear that the rule of law may get undermined. The freedom of press is already undermined according to various freedom of press surveys. So I mean, I think there certainly is this question going beyond sort of the macro financial conditionality, and that looks more at the political institutional conditionality. And I guess that's especially important if we were thinking of an IMF program to be complemented with a European macro-financial assistance program, where the European macro-financial assistance program has clear conditionality in that direction. So how do you see that?
Well, cronyism, it's not especially third world country type of syndrome. We've seen that. Remember the Asian crisis and all the discussion at the time in the late 90s about Korea, which is, a very advanced country now. There was this whole discussion about the cronyism in East Asia. So it's a plague, but it's a plague that is relatively common. What I think this and the political dimension call for is precisely to sort of, give an agency that's specialized in doing it the responsibility of dealing with the economic and financial and governance conditions of the program. It's not by accident that we have an agency that deals with that, instead of it being dealt with directly by governments, with all the problems of government having themselves particular interests and particular concerns in relationship with countries seeking assistance. Now, as you said, the EU is alongside the IMF providing macro-financial assistance to partner countries, to third countries. I mean, we've done that with a number of countries, and there are conditions attached. Traditionally the condition of having an IMF program, but on top of that, some also political conditions attached. It's democracy, it's the rule of law. At the same time, in the past, we provided macro-financial assistance to countries like Algeria, not sort of first-rate countries in terms of the rule of law and democracy. So we have to sort of square the political concern and political conditionality with the issues of what should be done vis-a-vis countries that are in our neighborhood, that are important partners, and that will be certainly part of what has to be discussed.
So I think that's a good point. Let me perhaps as a last question ask you about a tail risk and an extreme scenario, which is one where the conflict between President Erdogan and U.S. President Trump is insurmountable, and the U.S. president, and they really fall out of love with each other totally, which in the ultimate consequence could imply that the U.S. president decides that he would not support, as U.S. government, a program of the IMF. Now, strictly speaking, the U.S. I think doesn't have enough votes on its own to block a program. But it could probably try to mobilize others and so on. So let's think a little bit about such an extreme scenario where the IMF would basically become immobilized by U.S. opposition to such a program. So the agency that I think you rightly pointed out is best suited to deal with such a problem would not be available. At that stage, we have to do some thinking in Europe.
Absolutely, I think you're right to say it's a tail risk. It's an extreme scenario, but it's a risk we should be considering, because we've been very much used to consider that, the sort of the infrastructure of globalization that were initially created very much as the initiative of the U.S. I mean, in the context of the Bretton Woods system, they are sort of common infrastructure, and that they used according to multilateral principles. Now we're seeing that the behavior of the Trump administration is different in this regard. The attitude vis-à-vis the WTO. Now, we can't say what would be the attitude vis-à-vis an IMF program in the countries which has a particular conflict with the U.S., to which the U.S. is applying trade sanctions, not in a multilateral context, but in a strictly bilateral context. And the U.S. might want to block, we have to consider the U.S. might want to block a program of assistance to Turkey for bilateral reasons. And in this case, the question for the EU would be, it's our region, it's an important partner for us. What should we do? What could we do without the IMF? I mean, technically, the EU is able now to design a program. I mean, it was not the case before the Greek crisis, before the Irish crisis, but now we have the expertise we learned in this crisis. We have an institution, we have the ESM, we have the tools to put in place an assistance program. So the question, and that would be also something to investigate legally. It's not a treaty issue, but in terms of secondary legislation, it might be more difficult, because the principle is to provide assistance alongside the IMF and with this political condition we spoke about. But the question to consider would be, in the case there would be significant impediment coming from the US to an IMF program, whereas it would be economically, financially justified, and Turkey would be willing to apply for it. What should we do, and should the EU consider the option of going alone? I think we should work on the condition in which we would possibly have to go alone without the IMF.
Well, thank you very much, Jean, for joining us. Indeed, these are turbulent times in Turkey, an important country in our neighborhood, and I was very pleased to host in today's discussion Jean Pisani-Ferry, Senior Fellow at Bruegel, as well as Brett Setzer from the Council on Foreign Relations to discuss the situation in Turkey. Thank you very much.